Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the money world. You know how these companies like to play hide and seek with their numbers. Let's see if Summit Midstream Corporation got caught this time. Alright folks, buckle up, because we're diving deep into Summit Midstream Corporation's latest quarterly report. This isn't just a bunch of numbers, it's a story about how they're doing, what they're planning, and where they might be headed. And stick around because we're going to break down the most important financial figures, making sense of it all. Before we get into the nitty-gritty, if you're like me and you love understanding what's really going on behind the corporate jargon, then hit that subscribe button so you don't miss any of our future deep dives. We also have a fantastic community over on Discord. If you want to chat about these filings and more, it's linked in the description below. Now let's get to the numbers. Okay, first up, the balance sheet as of June 30, 2025, compared to December 31, 2024. Think of this as a snapshot of what the company owns and what it owes. Their total assets are up to about $2.4 billion. That's a nice increase from $2.3 billion at the end of last year, showing they're growing their business. But on the flip side, their total liabilities also went up, climbing to over $1.3 billion. This means they're taking on more debt or other obligations to fuel that growth, which is something we always keep an eye on. Now let's talk about profit, or in this case, a bit of a loss for the 3 months ending June 30th, 2025. They reported a net loss of over $4 million. That's a sharp turn from the same period last year when they actually had a net loss too, but it was much bigger, a much scarier loss of over $23 million. So while they didn't make a profit this quarter, it's still an improvement from last year, which is a glimmer of hope. But looking at the 6 months for the year, they're actually showing a small profit of just over $400,000. That's a massive turnaround from last year, which is a glimmer of hope. But looking at the 6 months for the year, they're actually showing a small profit of just over $400,000. That's a massive turnaround from last year, which is a glimmer of hope. But looking at the 6 months for the year, they're actually showing a small profit of just over $400,000. That's a massive turnaround from last year's 6-month period when they posted a profit of over $109 million. This big swing is largely due to some significant one-time events happening last year. Let's look at where the money is coming from. They're gathering services and related fees revenue that's like the core business income. It jumped by almost $19 million in the 3-month period compared to last year. That's a big jump, indicating more business is flowing through their pipelines. And their natural gas liquids and condensate sales also saw a healthy increase of over $18 million. This tells us that the actual products moving through their systems are also bringing in more cash, which is always a good sign. Across the 6 months, the story is similar. Gathering fees are up over $21 million and their product sales are up by almost $29 million. This growth is being driven by key acquisitions like the Tall Oak deal we saw finalized last year, which is really boosting their volumes. But business isn't free, you know. Their operation and maintenance costs went up significantly, a jump of about $15 million for the quarter and over $24 million for the 6 months. This surge in costs is happening alongside that revenue growth, so we need to see if the revenue growth is outpacing these rising expenses. Now, about that debt we mentioned earlier, interest expense is a big part of a company's costs. It actually decreased by a pretty significant amount, around $7.6 million for the quarter and over $22 million for the 6 months. This is mainly because they've been busy paying down or refinancing a lot of their older debts, like those 2026 unsecured notes and secured notes. The secured notes and secured notes, that's a smart move to reduce their financial burden. Let's zero in on their business segments, starting with the Rockies, where they operate in the Williston and DJ Basins. Natural gas volumes are up for the quarter and the year so far. Liquids volumes are also up slightly. This is good news, showing steady activity in that region driven by new well connections, and importantly the Moonrise acquisition. Then we move to the Mid-Con segment, which includes the Barnett Shale and now the Arkoma Basin, thanks to that Tall Oak acquisition. Here the numbers are really impressive. Natural gas throughput almost tripled for the quarter and more than doubled for the 6 months. This is directly linked to the Tall Oak deal coming online and also some previously curtailed production ramping back up. Financially, the Mid-Con segment reflects this boom, with revenues up a massive 279% for the quarter and 283% for the 6 months. This acquisition is clearly a game changer for them. However, the Northeast segment is a different story. This area, which included their Utica and Marcellus shale plays, has been largely offloaded. They sold off their Summit Utica assets in March and their Mountaineer Midstream system in May of last year. So as expected, their revenues and volumes there are now showing zero or very close to zero, reflecting these divestitures. This isn't necessarily bad. It shows they're focusing their resources on more profitable areas. The impact of these sales is also seen in their costs, with operation and maintenance, general and administrative, and depreciation all dropping to zero in this segment. It streamlines the business but also highlights the shift away from that region. Now let's talk about the costs that don't fit neatly into a specific segment, like general administrative expenses and overall interest expenses General and administrative costs did tick up slightly, but a big chunk of that increase seems to be from corporate severance expenses, a clear sign of restructuring or streamlining in some areas. And that interest expense, we saw a decrease in the overall company, was driven down significantly, partly due to debt paydowns and refinancings. This is a strategic move that should improve their financial health in the long run. Specifically, they refinanced and paid down a lot of debt related to their 2026 notes. Looking at cash flow from operations, it was positive for both periods, but significantly lower this year compared to last year. For the 6 months ended June 30th, 2025, operating cash flow was about $53 million. That's lower than the $30 million they generated in the same period last year. Remember, last year's numbers were boosted by those big asset sale gains. So while cash from operations is positive, it's important to see how that trend plays out without those one-off events. Investing activities tell a story of acquisitions this year. For the 6 months ended June 30th, 2025, they used about $120 million on investing activities, mostly for the Moonrise acquisition. This contrasts sharply with last year when they actually brought in over 600s, primarily from selling off major assets like Summit Utica and Mountaineer Midstream. Financing activities this year were a mix of borrowing and paying down debt. They borrowed about $95 million on their ABL facility and issued an additional $258 million in secured notes. But they also paid down $260 million on their ABL facility and made other debt repayments. Last year, financing activities used a much larger amount of cash, notably over $559 million, mostly from paying down debt to essentially clean up their balance sheet after those asset sales. Let's quickly glance at their stock situation. As of June 30, 2025, they had about 12.2 million shares of common stock outstanding. This is up from about 10.6 million at the end of last year, showing they've issued more stock, likely related to acquisitions and employee compensation. They also have Class B common stock, which is a bit interesting. It seems tied to that Tall Oak acquisition where they issued over 7.4 million shares of non-economic Class B stock. These shares apparently have voting rights but are primarily exchangeable for regular common stock. And then there's the Series A preferred stock, currently with about 65,000 shares outstanding. This stock ranks higher than common stock, meaning preferred shareholders get paid before common stock holders. Dividends on this stock were suspended for a while but have recently been reinstated. As of June 2025, they had over $46 million in accrued unpaid dividends on it. From my perspective, Summit Midstream is making some bold moves. They're clearly investing in growth with acquisitions like Moonrise and Tall Oak, which are already showing promising results, especially in the mid-ton segment. They're also wisely working to reduce their debt load, which should make them more financially stable. However, the increase in operating costs and the reliance on these acquisitions for growth are things to watch. The drop in profitability compared to last year is also worth noting, but it's understandable given the absence of those large asset sale gains from last year. They're transitioning their business, which always comes with some financial turbulency compared to last year, is also worth noting, but it's understandable given the absence of those large asset sale gains from last year. They're transitioning their business, which always comes with some financial turbulence. So what's my take? Summit Midstream is actively reshaping its business-making strategic moves to focus on higher growth areas and clean up its finances. It's a bit of a mixed bag right now with improved volumes and revenue, but also rising costs and a more complex equity structure to manage. The key will be whether they can continue to integrate these acquisitions effectively and manage those rising expenses to turn that small profit into something more substantial. Investors will want to keep a close eye on their debt levels and operational efficiency going forward. Alright, that's our breakdown of Summit Midstream's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.